Bitcoin's failure to bounce back even as other risky assets surge could be the canary in the coal mine for speculative markets, signalling that tougher times may lie ahead. For more, we're joined by David Scutt from StoneX. Why has Bitcoin struggled to recover but other asset risks are actually still rallying?
G'day Aaron, great to be back, and a really good question because we know that Bitcoin typically leads riskier asset classes, highly speculative asset, beneficiary of what changes we see in liquidity in the marketplace. And we saw a big drawdown 2 Fridays ago, and that was sparked by trade concerns. Donald Trump threatened to go and put 100% tariffs on China, and for some reason that had a really negative impact on Bitcoin. And then in the period since, it's not been able to go and bounce back, where if you look at all the other riskier asset classes, they all have. And because Bitcoin tends to lead, it could well be that canary in the coal mine for what we see elsewhere in the weeks and potentially months ahead.
Talk us through some of the charts. Let's have a look at this one here at the moment, showing, I guess, Bitcoin to the US dollar.
Yeah, so what we're looking at here is the daily chart for Bitcoin and just some really basic technicals, because when I look at Bitcoin, I don't really think there's much underpinning other than price action. So I pay a lot of attention to what the price signals are. We can see what's called a shooting star at the top. That was just before that Trump announcement came out a couple of Fridays ago. It was already looking really iffy right then. And then we see that big pullback, and then there's so inability to go and bounce. We had a very, very minor one earlier this week, but that was sold into. And then overnight, we've had the completion of what's known as an evening star. That's another bearish reversal pattern, and it's now testing support at 107,500. And if that breaks down, it points to the potential for a much deeper flush, which could have ramifications elsewhere.
What about this one here? So we're looking at BTC versus gold and NASDAQ.
Yeah, so from left to right, we've got Bitcoin, gold spot price, we've got NASDAQ futures, and we have NVIDIA's share price. And so what you can see when it comes to Bitcoin, it's had quite a substantial drawdown already. It's over 15% from the highs. We're seeing gold as well, which was trading very similar, the kind of price action you expect to see in crypto markets over the course of recent months. It's also had a big drawdown, a sudden one as well earlier this week, but still nowhere near a scale of the decline seen in Bitcoin. And then you look at NASDAQ, you look at NVIDIA, basically the poster child for the AI rally, and they haven't really rolled over anything at this point in time. And so that's why I'm concerned that if we see a big, meaningful breakdown in Bitcoin, it could be a sign of what's to come in other markets that are very high beta risk plays.
Well, that's my next question. What does, I guess, Bitcoin's weakness tell us about the broader market liquidity? Because we've been facing warnings that something big is going to happen for quite some time. What do you think the warning is here?
It's a really difficult environment to go and try and explain. A few people have been asking me this over the course of the week. How do you see like general sentiment in markets, and why do you think that some risk assets are struggling like Bitcoin and others aren't? I think people are nervous, but nervous for 2 reasons. They're nervous because they're looking at valuations, they're looking at all the good news that's priced in. And at this point in time, it's very hard to say, well, I don't want to be invested in this market. So people are constantly looking to go and buy the dip. But at the same time, when you've got everything priced at perfection and then it still can't go and rally, that should make people nervous as well.
Are precious metals' sudden declines also another warning sign, what we've seen with gold and silver this week?
I would say so, yes. Really, really hot markets. And anyone who's been around and looked at markets in a considerable period of time would know that the price action that we're seeing in these precious metals is really what you'd expect to go and see in the crypto space when things are really ripping high there. So there was a bit of a talk that potentially we saw some shifting from people out of crypto into these precious metals, which may explain the price action. But I've got to say, whilst it was creating a lot of great headlines and a lot of people were getting wealthy very quickly given what was going on with the price, a healthy bull market does not go up in a straight line. And that's what we saw with precious metals for a long period of time over the course of recent months. So the pullback that we saw and how abrupt it was not sparked by any fundamental news whatsoever. That's another warning sign, a quake, a tremor that potentially could be something far more sinister ahead. There is still a lot of speculative price action that's built into what's been going on in that space. So just be careful buying the dip in this environment, because all the price signals suggest that there are risks skewing to the downside.
Gosh, you got to feel for all those people who are queuing up in Martin Place outside the gold stores.
To a certain degree, But I've got to say, a lot of these people, and I've been reading some of the comments. Obviously, I used to be in Sydney a lot, and I know at ABC Bullion that store is where a lot of people are particularly lining up at this point. And I'm hearing all this stuff about debasement trade, and people are concerned about what's going on with the US debt situation, what's going on with the Federal Reserve, etc. And I get that. But where were the arguments for that back when gold was trading beneath 2,000 an ounce about 3 years ago? Because that was the moment to go and start questioning that. Because back then, we had the US government running massive deficits, much bigger than what we see today. We had the Federal Reserve printing money like confetti. That was the time to go and start using those arguments, not when the price has more than doubled in the space of a couple of years.
Talk to us about the froth that's been removed from the markets. Is it truly gone now, do you think?
It's a good question, and we don't know straight off the bat. Obviously, some of those excesses that have built up over the course of recent weeks and potentially months, depending which asset you're talking about, may have gone and been eradicated. But I'd suggest that just given how far we've seen these markets move, it will be very difficult to go and eradicate that entirely in just one swift movement. You need to see proper pain. And when you talk about some of the market movements in the precious metal space in particular, yes, we saw the biggest decline in X number of years. I think it was more than 12 years for gold, but it still just scratches the surface. It's still up more than 50% this year. To go and be really certain that we're seeing a big eradication of those speculative market forces, we need to see a lot more pain, and we haven't seen that yet.
All right, we've spoken about gold, we've spoken about metals, we've spoken about BTC. Do you think US stocks could now be next to feel the pressure?
It could be, but of course, when you look at stocks, there is a fundamental catalyst to it, and that is earnings. And of course, we're in earnings season right now. But we know that, unlike these other asset classes that have run very hard and then started to reverse, that their valuations by a historic standpoint are very, very lofty. And whilst earnings season to date so far in the United States has been a string of beats, I think it's like 85%, which is the highest level seen since 2021, we've seen that when companies don't guide to what markets are expecting, and that's where elevated expectations are now built in, because we've seen this significant beat rate, they get hammered pretty aggressively. We've seen that with Netflix, we've seen it with Tesla earlier today. Decent numbers coming through relative to what market analysts were looking for, but market expectations, clearly the bar is a lot higher.
Well, talk to us about Tesla. What are we seeing here?
Yeah, look, record quarterly revenues, obviously a good thing there. Profitability, though, hampered significantly, down about nearly 40% relative to the same quarter a year ago. Right now, the earnings conferences, I can see Elon Musk in the background giving his spiel. It's always interesting to go. Tesla's trades to me a bit more like a meme stock. It trades at ridiculously high earnings evaluations. But next week is going to be the one that I think is going to be the really key one, when we start to see those AI beneficiaries coming through. What will they report? And how, not just what market analysts are expecting, but what are markets expecting from those companies? And that's where the risk could be, that we could see a repeat of what we've seen in Bitcoin, what we've seen in precious metals, and a decent pullback.
Could that be a trigger? I mean, AI has been so heavily overblown, as you say. I mean, talk about frothy. The AI sector has had billions thrown at it with not a huge amount to show for it. And a lot of warnings from companies saying, great, in the tech world, hasn't made the productivity gains we were hoping for. If that flows through, is this similar to the moment that the streaming giants were told, make money, it's not just about getting more viewers?
At some point, that will come to fruition. And you're right, a lot of the hype that's built into the AI and the revenues that were supposedly going to come for it, there's still not a lot of evidence from it. We can see them when it comes to some of the advertising, Meta in particular, they've been a beneficiary so far, but there's still not a lot of concrete evidence elsewhere. You're right, it could be that moment where there's disappointment, that could be that trigger that sparks the pullback. But what would be more concerning is that these companies went and topped expectations, and then the shares are unable to rally. And that's often seen around market peaks, where everything looks so great and you get a great result and then it doesn't actually rally. That's what I'm more looking for in this particular reporting season from these big tech giants, because there is just so much good news priced in. It's going to become increasingly hard to go and impress market participants, not just forecasters.
All right, David Scott, appreciate your time as always. Thank you.
Great to be here.